In this video, traders look at 3 types of market bottom. Stay tuned. Hey guys, warm welcome to you. Right, so 3 types of bottom. No laughing at the back. Market bottom. So is that a swing trade, a day trade? It's the same for either, but guys, if you're on a 1 minute time frame, 15 to 5, or they're even on a daily time frame, these are super common and some of the 3 most common ones that I see in the bottom, so in the market. So 3 types of bottom and some ideas on how to trade them. All right, so the first one is the V. So the V is really when the market literally goes to the downside, rips to the upside, and there are 2 ways of getting onto that. The first one is that you're looking for some kind of exhaustion here, so some kind of a long candle with a decent volume that spikes straight back up. That is often the indication of the low. The second way of looking at it, or second way of trading it, is to wait for the bounce and then try and buy a kind of pullback after you've seen strength. Yes, it can be a little bit late, but when you've got plenty of room to the upside to go, then it's not too bad because you've still got a lot of legs in the deal. And this is nice, obviously, on a swing trading perspective as well. If you've got a target up here, or on a day trading perspective, that happens to be the gap or something like that, you've still got plenty of legs on it and you can still kind of quantify your risk. But sometimes if you can't kind of spot that exhaustion, or you're not there when it happens, very often you're not sitting in front of the screen, that's fine. You wait for that and then wait for a subsequent pullback after a move. It's not too bad. So the W, that's the next one. So the W is pretty self-explanatory, guys. It's a W, a double bottom. It could also be a multiple bottom, triple bottom, or kind of multiple test at a key level. A couple of ways you can trade that. First one is you're either looking for a move back through the low here. So this is the kind of trade you get, a push up, comes back, and then you're trading that kind of move there, break through the low, or you're trading kind of either a test here and a deeper stop or something like that. A standard double bottom type trade. Or you wait for it to break through the most recent high after the second test. So test 1 and test 2, and let's call that A because it's the first high. You're basically looking at B. So when it breaks through that high again, you're buying a breakout trade. Now, advantage of that, of course, is that you've waited until you've seen some kind of strength come in. Disadvantages, of course, is that you're quite late to the party. But if you can find a way of framing that trade, and it's not too bad, it's reasonable. And sometimes you're in a situation where you don't really want to be doing that. Maybe it's really horrible downtrend. Maybe this stock or whatever market currency pair has been hammered for days and days and days, and you only kind of just getting this, and you're like, well, I'm not that convinced, but I don't really want to be buying this here because it's not that great. We've been in a severe downtrend. It looks like it's going to continue. But when you get a reversal, then you can think, all right, well, I'll wait until I see that. Obviously, it depends on where this occurs, because if it's occurring in a different position, we're all over this as soon as we can be, and we're prepared to take a bit of risk there. When it's in other positions, when depending on what's happening on this side of the trade, we really want to be cautious about it and perhaps wait for a little bit more confirmation before we pull the trigger on that. Okay, so those are 2. Another one is the rounding bottom. This is the one I'm not a big fan of, because what happens is generally you come down and you kind of sit at lows, volume just really dries off. Not much going on, very, very slow, very tricky as well to get on, and then it kind of starts to pick up and maybe starts to pick up momentum. I don't really have a good entry point for you on this that I can reasonably stand up here and go, yeah, I would take that. If you were to ask me for a way to get into this trade, you could say, okay, we'll start to draw some resistance here and maybe buy a break on that. As long as you can quantify the risk and have a stop under the low, fine. I wouldn't like that myself because I'm mindful that very often you kind of little fake breaks and come back because there's no real momentum. The only time I would really like this kind of trade is, obviously, if you're in this, what I call the sort of third phase of the trade. Imagine that's the first phase, that's the second phase, that's the third. If we're in that phase, then you can play this kind of game of waiting for a pullback, of course. That goes without saying. And if you've got plenty of upside there, you've got all this area to potentially, go long at some point if you've got a decent upside potential there. The other way to do this is if you're looking in the phase 2, if you like, of the trade, so it's phase 1, that's phase 3. If we're in phase 2, then if there's some catalyst, right? So if you have some kind of news, let's say you're trading currency pair, something comes out that's reasonably bullish for the country you're trading, obviously the pair's in the right direction, stock news or something, then maybe you can consider it and go, well, actually, we found support here. Yes, there are no buyers yet, which is why I'm not so keen on it because you're literally just holding at lows. And in reality, if you look at the hard right chart, forget about this for a second, you're just looking at that. That's just a horrible bear flag, and it's something that you'd be looking to short for new lows. So that's why I don't really like this so much, fading it, because I'm always looking for a continuation if we get this kind of system, this type of setup, should I say. Obviously, again, depending on where we are, what's happened prior, have we pushed up prior, that would be a lot different to if we moved down prior. So, you know, it's very challenging sometimes for us to just isolate this, just give us an idea of what we're doing. So there, catalyst, might be tempted to go on as a positive catalyst, have a go, stop below the low. Otherwise, waiting for strength and having to pay up a little bit, and of course trying to work out some risk and stop placements from that. So guys, those are three, I think, the most common types of bottom. You got the V, you got the W, and the rounding bottom. Of course, you've got variations. That sometimes the W might go a lot lower and then go higher. So you've got the lower low, higher high, or maybe you've got a higher low and a higher high. You might not get that kind of move there. Different variations, but broadly speaking, those are some good themes to work on. All right, guys, keep yours managed. And if you're new here, consider subscribing for more videos from me on this channel. Take care. Bye-bye.